with us all the while have been noticing that we have been correctly talking about uh, the rates going to go up, the rupee going to 80, and also helping investors and financial advisors and wealth managers position portfolios, fixed income portfolios, with the strategies like ladder and identifying the right bonds to invest in and helping them invest through a platform. And now with what it looks like is that volatility is not going to subside soon. And also we have been very vocal on the fact that central banks have been way too loose for too long a time. And this is going to have its implosion or explosion, whatever you call it. And that is what is happening at this point of time. So in our agenda today, I'll take you through the issues facing global central banks, then RBI policy itself, what it can do, and also how to position your portfolios, the bond strategies to consider in this current market environment. Just as a housekeeping, any of you want to pose any query while I'm talking, you can always raise your hand and Ketan will unmute you. Or you can post it on the chat and Ketan will raise a question to me. And this webinar is recorded. So, and the presentation, we will send you the presentation and the recording post the once we after the completion of the webinar. Once again, thank you for attending the webinar. And yeah, so let's move on. So let me take the first part of the topic, which is the global central banks and what is happening there. So now, actually, the very recent crisis is the pension funds in UK, and most of you must have read about that, or you must have been following this. That because of such ultra low rates, many pension funds in the UK had to resort to very risky strategies, including risk assets, derivatives, etc. And with the volatility in the global bond market in the UK, many of these structures they have put on have gone deeply out of the money, and the margin calls have kicked in, and all the assets are being sold on a fire sale basis. And the UK central bank, Bank of England, had to resort to actually announce critical measure of buying government bonds to while actually they were saying that they will be selling government bonds earlier to keep liquidity tight, as they were even hiking rates very sharply. Now we all know that just before the crisis erupted, that there was $16 trillion or euros or dollars of bonds that were in negative territory. Now, if you look at all these bond deals, they've gone up substantially higher. And just to give you a anecdotal example, an Austrian 100-year bond has lost 72% of its value in this fall. So there's been a huge collapse in government bond deals, and we have been saying that for a long time that the riskiest asset class globally, because of central banks keeping ultra loose monetary policy for too long, is the government bond market. And this has come true. The question is, where is it from here? So clearly the Fed is hiking rates by 75 basis points. If you look at the Fed fund futures, it's talking about a Fed fund rate at 4 to 4.25. You have an inverted US Treasury yield curve. And the Eurozone, I think, is in the same place, the European Central Bank. Unfortunately, they have to contend with another factor, which is eruption of the PIX crisis, where Italian bond yields are closer to 5% and higher, and many other countries' bond yields rising sharply. And at these yields, they cannot sustain the debt. So clearly, you are in a crisis position. And how is it going to pan out? It really remains to be seen because the uncertainty is still there. You have still the uh, geopolitical tensions, and so you have one part of the world that is, you know, in a constant state of flux, and that is not helping the cause either. So all this put together is clearly telling on markets. You had the uh, euro coming to parity. You had the British pound falling to its many decade low levels. Then you had its repercussions on EM currencies, including the rupee. And if all of you must have heard RBI, I'll come to the RBI policy soon. And obviously, also equity markets have been falling sharply. And in the credit side, the if you take US junk bond yields, they have risen very sharply. The CDS credit derivative swap, the spreads are rising. And clearly, there are lot of companies have been cut off from dollar funding. So one route of liquidity is gone for issuers, and and those who have issued dollar debt have to face are facing higher their interest rates going forward, because of the depreciation of the rupee. So clearly, it points out to a 2008 to kind or a 2013 kind of scenario. 2008, it was a credit crisis, but this time it's caused by central banks and government bonds. The repercussions can be pretty sharp. Um, so that's where on the global, couple of things I would like to highlight here is the rate differential between the Fed fund rate and the RBI repo rate has come down substantially. While it was close to 4% some time back, it's now just around 2%. And what does this mean? So some signs of interpretation could mean that maybe India is in a better position, and with so-called developed countries are now becoming um, what emerging market countries, if I may say so. Maybe India is seeing a better is seen in a better light. Hence, this differential can last. But on the other hand, if if there is a tendency by both domestic investors and by traders definitely are doing this, is to park money in US dollar bonds or deposits, take advantage of the higher rates as well as the currency in their depreciation. Then they are in a healthy uh, return position. And if more and more of this happens because RBI is going slow on rate hikes, then you could face a situation where the currency continues to depreciate very sharply, the rupee. So this particular trend of the spread differential narrowing between Fed fund futures and the RBI repo rate has to be watched very closely, and what could be the repercussions. Now let's come down to the RBI policy today. The governor sounded pretty much confident of what they were doing. They didn't show any signs of panic. If you remember in 2013, when such a crisis happened, the then central bank governor Raghuram Rajan, he raised the MSF rate by 3%, that making funds very tight, costly for traders to or investors to borrow and short sell the currency. Now, our RBI governor hasn't done that this time, and they just raised policy rates by 50 basis points and just kept the uh, tightening stance as a guidance. They were confident on inflation coming off next year and reasonable growth expectations. Um, and even on the rupee front, the rupee depreciation front, they did downplay it to a very large extent. They have been selling dollars. They have depleted FX reserves. Their forward position has come down, but there was no move towards raising funds through either FCNRB deposits or through any kind of a special bond, SBI bond, a dollar bond. Nothing of this sort. Now, is this a confident RBI that is seeing something we don't know, or is it that RBI is trying to act confident when things are going all over the place? Hopefully, it's the former, and the RBI is very confident. But having said that, there are still a lot of, but there are still positives and negatives. The negative side, you have a widening trade deficit, which is taking up the current account deficit. So that is definitely a cause of concern because when the FX reserves fall, then India's import cover also comes down. And when external debt has been pretty okay, but when ratios start to weaken, then the currency could come into a fresh light. Second is obviously the 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 uncertainty surrounding the global uh, markets, where the crisis will end, where all um, where all the excesses have will come out, and what can happen going forward. And then you have on the geopolitical side, you have when the question of the Russia-Ukraine standoff, then you have China on one side becoming closer, more and more closed. And clearly all that is hurting. But on the positive side, India has, uh, we have seen a couple of things that is pretty much positive. One is that tax collections have been very strong, especially GST. To some extent, it's largely due to higher commodity prices and also due to the fact that also due to inflation. So put together, the government revenues are pretty good, and they have been able to uh, stay well within their budget in terms of the deficit. In fact, it's well below the budget until August, I think. RBI governor did say that the government can spend going next year. I mean, into the second half of this year. The second is that um, the fact the inclusion of the bond in of the JSEX in the global bond indices. Now, this is very much warranted, given that many countries like Russia have to be taken off. And but only thing is, while in September that the JP Morgan is very confident it'll take off this month itself, but now it's saying they're postponing it to next year, early next year, 23. Hopefully it'll happen soon, but the main thing is about the flows. Will that happen, and how fast will it happen? So indications are that even in the first year, if say 2000 FY24, you have about 30 to 50, $40 billion coming in, then it could mean that the absorption of government borrowing will be much better for the market. But having said that, it'll always come at a cost, and hopefully the cost is not very high. So these two, I mean, at least on the fiscal side, and on the inclusion, it's a pretty positive um, factor. Also, we do have indications that because of extreme uh, price pressures in the euro in Europe, a lot of them are closing down their capacities and getting the capacities into India. China at this point of time is a closed door. So India is seeing benefits of that. And if that continues, that means you could have a very stronger economy going ahead with the higher exports. Um, this clearly is a positive for the economy. And if the so growth expectation could still stay high, high, and also capital flows. Given that one part of the world, which is Russia, which is closed, and China, which is again getting more and more closed, all that allocation could come into the country, and that could improve the uh, flows. So you do have some positives going forward, but it all depends on the fact that how the global crisis will pan out, and if there is degrowth in Europe and US, which are the two of the biggest economies in the world, then there will definitely be a fall in demand, and that could um, negate any kind of positive on the growth front. So with bearing this in mind, so what do you expect? What do we expect bond yields and do? And how do investors position their portfolios? Right now, coming down to the first point, um, how do investors position portfolios? You have you could have um, sorry the first point of the first position I would say is to position for sharper rate hikes and tight liquidity. So when you're positioning for sharper rate hikes and tight liquidity, you potentially have fear. Uh, the sharper rate hikes will happen because, like I was saying, that the rupee will still come under pressure because RBI is still going slow, and because of the rate differentials coming off, you could have a situation where a lot of money flows back into US dollar assets, and and uh, this can actually lead to further depreciation of the rupee. And to counter this, RBI will have to hike rates sharply. And because of the dollar outflows, the liquidity will also likely to tighten. Um, and also, one aspect of liquidity is that because of the high inflation, the credit growth has also been very high in the system. If you look at the incremental credit deposit ratio, it is closer to 107, well over 100%. And this was actually around 29, 30% just after the COVID. So clearly, so with so much of credit going out and deposits are not growing fast enough, banks are still struggling for liquidity. And when they're struggling for liquidity, that they are hiking deposit rates. They're high all and they'll set the benchmark. And if you take the uh, OIS yields, the swap yields, the 1 and 5 year yields are closer to 7%, indicating that overnight rates will go to 7% levels. which is still very okay considering that, in 2013, the rates were closer to 10%. And here we are just around 7%. So there has been a downward shift in the whole curve. And if this holds, that means it's very positive for the economy and for investors as well. But in the short term, clearly you do see rates rising and tight liquidity conditions prevailing. And this is so in one way, bond issuers should actually try to issue as much bonds as they can, and investors too will have to start calibrating on how much bonds they want to uh, take up, and so hence they must demand their price to other bonds they want to invest in. And coming down to the second point, which is we have to position for higher credit risk because of rising rates and tight liquidity and issue in global bond markets. Like there could be a liquidity crunch, especially for weaker borrowers, and those the borrowers who have been uh, one is have a lot of redemptions coming up in 23, 24. In the last couple of years, we have seen many issuers raise a good amount of money in the 23, 24 maturity band. And all this will come up for redemption. And if tight rates and liquidity conditions prevail, then they could face refinance risk. And we have seen what happens when issuers don't get refinanced, they tend to default. The second is that if you're leveraged companies, that is, if the companies that are very highly leveraged, especially taken out in the last couple of years, uh, and with tighter demand conditions, there could be there could, and we have also seen that a lot of leverage has gone into retail loans. And if the retail loans start to go bad or get into trouble because of a weaker economy, then there is a problem where again the balance sheets get weaker, and they may not be able to increase capital adequacy through equity infusion. So it can go down. The weakness could continue, and there could be higher credit spreads. And then in the um third factor in this is that very many borrowers that have been funded by private equity and need more to raise more funds from the PEs. They start with Series A, then go down to all over any series. Uh, if they're not able to raise further funds, then they could get into trouble. And this is possible because of one is again global risk aversion, and second is tighter liquidity conditions globally. And if a lot of investors could also actually hold back putting money into PE funds, given that in this kind of markets, many funds will have problems in terms of delivering returns. So that's on the positioning on the for higher credit risk. But there are also positives, like I was mentioning. Um, there are also positives, like I was mentioning. One is clearly that inclusion in the bond index, which could increase flows next year. That's a pretty much positive. Then you have improved tax collections. Then you have also the fact that the volatility in global markets could peak out. And maybe we could also have a, a position where central banks globally are able to handle their crisis and bring stability to markets. So how do you position in this? Our favorite is a bond ladder where you invest across maturities, giving weights, calibrating weights with maybe depending on the rates uh, um, uh, and also the risk ability, and invest across a span across a range of maturity from say 1 year to 10 years. You could, I mean, you could put 3 or 4 bonds or 4 or 5 bonds or how many ever bonds. And this ladders could actually work well for investors. It's been working very well for INR bonds. Those who have taken up INR bonds ladders, those who have been following us, we have been sending you communication of how these ladders have performed. They have outperformed about 4 to 5% in this market. And so hence with a ladder, what you can do is that you can actually be exposed to the longer end of the curve to take advantage of the longer term positives. And the short end investments will give you the higher rates required. And also the short maturities will get your money back fast, and you can reinvest it in either long duration bonds or more short duration bonds as the case may be. So this is on the strategy side. So clearly, if you ask me to conclude, the crisis is not over. I mean, it's still a long way to go. So you have to position for uncertainty. What's clearly going to happen is more rate hikes and tighter liquidity. Again, that's going to be a case. And what could be positive is that things get better next year. We don't know about it. So so clearly you don't go and load up on duration or load up on credits or anything. And also that credit risk is going to going to increase. And so clearly the positioning is there. So check the credits you're investing, check the positioning for uncertainty, check positioning for um, short-term rate hikes and tight liquidity, and check positioning for potential positives going forward. If you put all these check marks, I think you got a good portfolio going. Now with this, I'll stop and I'll take any questions you have. It's a free discussions. If anybody wants to pass their comments, um, feel free to do so. It's just not a quick Q&A. You can make it a discussion session. Anyone wants to raise a point or ask a question can either raise the hands and Ketan will unmute, or you can put it on the chat box.
Uh, so we have a question from Mr. Swaminathan R. He want to ask, will the government revise the interest rates for saving schemes?
Yes, if interest rates are higher and they are benchmarked to the 10-year, so they will raise interest rates for saving schemes if the 10-year continues to rise in terms of yields.
We have another question from Mr. Manoj. Please unmute yourself and ask the question, sir.
Very good afternoon.
Hi, good afternoon.
It is pleasure to talking, Parthasarathy. My question is, shall we go for floating rate bond from this point?
Um, it's a very good question. Floating rate bonds have definitely not performed at all. But those bonds which are benchmarked towards the short-term rates or overnight 3-month T-bill or anything benchmarked to 1 year OIS, uh, the yields will definitely go up. The only problem with floating rate bonds is while you can take advantage of the higher coupons available in the short term, the pricing of the bonds becomes a big issue, especially if they are longer term maturity. So if you can find any floating rate bonds that are maturing in the 1 to 2 years or maximum 3 years, actually 2 years I would prefer. Then if you can find those and they're available at reasonable prices, then you can definitely invest in.
My another question is, according to ladder strategy, what proportion should be kept for the next 3 years?
I would say that uh, you could have at least about 50 to 60% for in the 1 to 2 year maximum, and then the rest spread over 3 to 10 years.
Thank you very much.
Welcome.
We have another question from Mr. Vijay Bavri. He has a question like floating rate bonds saw continued supply in H1 FY23. With no supply in the second half, aren't you expecting some re-rating to happen in that segment? For example, the reset coupon on FRB 2033 is at 743, higher than the 10-year GSEC yield.
Uh, yeah, like I said, right? These are too long maturity bonds and very difficult for anyone to price how the bonds will be priced in the next 2 years. So if you buy for a 743 coupon for 6 months, have to be certain that you can sell it at the same price after the next 6 months. And if the price is if you're not sure that you can sell it at the same price, then you're buying it's like you're buying a 2033 bond at 743 and not able to sell it. So that's my only concern on these bonds. Having said that, you can see this coupon rates being set higher only. So hopefully the prices will react accordingly. But my only uncertainty here is that fact is the market is just not able to price these bonds well, and liquidity is very low in these bonds. Yeah. Does that answer your question?
So he has another point, Mr. Vijay Bavri. He's saying that the OIS
Mhm.
curve is now pricing in terminal repo rate at 7%, implying another 110 basis point rate hike.
Okay. Yes, clearly. I mean, typically the swap is a sentiment factor as well. And the overnight rates are still closer to 6% after this repo rate hikes. But if somebody is willing to take a negative carry for a year of 1%, clearly they expect rates to move up. Now, like I was saying, I think the rates will have to go up. And I would rather not go against the swap rate at this point of time.
So we have another question from Mr. Ramesh Yadav. He is saying everyone is saying that there is liquidity crunch with banks. but then they have around 8,000 crores parked with RBI and SDF. 80,000 crores parked with the RBI and SDF.
Hello.
Hello.
Yeah, yeah. Okay, the liquidity crunch, like I was saying, is coming from the fact that credit is growing much faster than deposits. And so given that it's well over 100%. And because of this, and then with RBI selling dollars and overall liquidity conditions staying weak and government maybe not spending enough. So there is definitely a tightness in liquidity. So hence they have to, one is either collect more deposits by paying higher cost or sell their GSEC holdings. So both ways, the rates, if they sell GSECs and nobody is there to buy it, then GSEC will rise and they will not participate in auctions as well. Or if they raise deposit rates, then short-term rates will rise anyways. So liquidity crunch is definitely there if you look at this incremental credit deposit ratio. Welcome for all of you. Anybody else wants to raise a point? Okay, if there are no questions, uh, um, happy to take your queries even after this close of this webinar. All you need to do is send a WhatsApp to Ketan or send an email and you can contact us. And do log in to INR Bonds for our research, those of you who want training. And obviously for all those who wants to see the best bonds to invest in, we have our partner portal. If you're a financial advisor or wealth manager, you have your own portal where you manage your clients, select bonds and invest for them. We have our app, which is Quick Invest, so that we curate bonds with our own risk model. And also our new market watch gives you all the best prices of and offers of bonds by various providers in the market. And all you need to do is, it's an RFQ platform. All you have to do is just log in and check the offers or bids, and you can actually transact with what you want to check. Thank you very much, and have a good week.